Brazil, and so her specialty is behavioral economics, and so she will present her the application of her theory of the information perception curve to investing. Julia Dupire.
Thank you. So yeah, I'm going to be talking a little bit about behavioral finance today. So in short, behavioral finance really is peering into the cognitive biases that we all succumb to in order to explain market irrationality and errors in decision-making and investments. So traditional economics really is more based on traditional concepts around rationality, and behavioral economics is trying to look at actualized behavior and explaining kind of the reasonings why those might not really abide to the traditional models. So the context for today's talk is really based around also information overload. So there are a lot of explicit and implicit kind of initiatives for companies to disclose more information nowadays because of government control, for instance. And so with this abundance of information and its accessibility online, people might have more access to information. However, they don't necessarily have better ways of understanding the quality of that information. And ultimately, more information doesn't always mean better decision making. So today I'm going to be talking about an information perception theory. And really what this is a framework for understanding the ways that individuals perceive information and behave according to it. So it's really looking at different stages of looking at information and how each one of these actually abide to different cognitive biases. So this curve kind of gives you more of an idea of how to understand this information perception theory. So really it is mainly at the beginning kind of going into a very steep learning curve, and then it kind of plateaus off. And so the y-axis is information perception, or rather attention to information and absorption of that information. And then the x-axis is information exposure. So looking at how people absorb information over time. And the first stage is first impression. The second stage is information assumption building. The third stage is cognitive dissonance, and then the fourth stage is stabilization. So going into the first impression phase, really people can go about, for instance, looking at a new asset class with no prior knowledge. And that means that the context, the framing of this initial information and the source of that information is going to be extremely important in the way that the information is going to be absorbed, attended to, and perceived. So here we have a very steep learning curve at first. So people are really asserting a lot of emphasis and importance to this first stage. And this information becomes formative of how they're going to see this asset class as a whole. So the behavioral biases around this are the herding bias, the framing effect, and the negativity bias. And I'm going to give more examples as of how to kind of better understand how these have market implications. So for the herding bias, investors tend to follow trends. And so we see kind of certain trends gaining a lot of momentum in markets, and this tends to actually lead to overpricing of certain assets, and people enter the game too late with this bias. So ultimately, this leads to market collapses. And we've seen this, for instance, with the dot-com bubble. And we can estimate that this is also kind of what's happening with cryptocurrencies at the moment, as well as marijuana farming. Now, if we look at this graph, it's looking at the logarithm of closing prices and the logarithm of hits in Google. So we can see that exponentially, as intrigue or interest or popularity increases in Google, it also exponentially increases the closing prices. So the framing effect is essentially the context in which information is presented, and that completely shifts the way that that information is going to be perceived. So a big application of this is looking at losses versus gains, and presenting something as a loss or presenting something as a gain is giving you much more kind of a concept of how you're going to perceive it in the future. So this was in one of the headlines about Bitcoin. So looking kind of at a very short time series and seeing Bitcoin as in gains versus the S&P 500 in losses. And so using that reference point kind of to skew more towards Bitcoin. So next we have the negativity bias. And this essentially is the tendency for investors to weigh bad news over the good news. And ultimately, that leads to risks not being proportionally weighed according to potential rewards. And negative news has tremendous disproportional impact on equity markets. So for instance, Shen, in his research in 2003, showed that when comparing a portfolio of stocks all with somewhat equivalent returns, the stocks that had headlines written about them, positive or negative, tended to do far worse in future months than the stocks with no very clear public news written about them. Similarly, Akhtar in 2011 had conducted a study where he was looking at consumer sentiments, and he saw that after announcement day of these consumer sentiments, the consumer sentiments with negative news tended to very significantly impact the equity markets, whereas that wasn't the case for positive news. So positive news had no effect. This leads us to the second stage of information perception, which is assumption building. So information is extracted from the first impression, and from there, people are going to compare that information with pre-existing mental models that they might have in mind. So you have frames of reference that are then going to be categorized. And from categorizing this information, assumptions are going to be built. Now, the important thing to take into account with assumptions is that often you're going to have predictions that are indicative also of reflections of what one's aspirations or fears about the market are going to be. The cognitive biases that are implemented with this stage are trend following, overconfidence, and confirmation bias. So with trend following, that's really looking at how investors tend to look at what the market has done in the past and think of that as indicative of future market evolutions. And people really are persistent in their optimism. So if, for instance, a stock has done very well in the past, people tend to think that that's going to continue in the future. So for instance, when looking at the marijuana farming industry and its high growth rate recently, a lot of it is actually due to changes in regulation. So for instance, legalization in California. And so this shows us that it's expected to yield high growth in 2019 and 2020. However, there's not really any strong indicators that legalization is going to expand. So this is an example then of trend following bias. We also have overconfidence. So people tend to overestimate their abilities as well as their small probabilities. So this is, for example, the case with ICOs. So there's a lot of overconfidence around cryptocurrencies, which has led to an overflow of ICOs. And we can see that there's a coin overvaluation now happening in the market, and this is creating really unsustainable markets. So tangential to this, we have the confirmation bias. And really, it's once that people have assumptions made about something, they tend to selectively pay attention to information that's going to confirm their beliefs. So here, for instance, let's say in blue, we have all of the facts about cryptocurrencies. And in red, we have an investor's beliefs that they are on the rise. Now, positive information about Bitcoin, for instance, is going to be what's in the middle here. And that's going to tend to be overvalued. And then people underestimate the import of the rest of what is in blue. So that brings us to the third stage of the information perception curve, which is cognitive dissonance. And so we can see that there is a slight bump after stage 2, and really what the reason behind that is that inevitably when you're making decisions off of very little information, so like the first impression, then you're ultimately always going to find deviations of what is actually happening versus what you assumed would happen. And that causes a lot of cognitive dissonance because of this difference then in between what you predicted and what has been realized. So according to this theory, then you have to recalibrate your assumptions in order to factor in kind of all of these deviations. And that's why the curve starts plateauing after this point. So an example of this is the assumption that Bitcoin will rise in value, which was the case with a lot of the herding happening in 2017 when the stock price was nearing 20,000 for each Bitcoin, and now looking at the actualized Bitcoin price, which crashed in January and now has received a new low of below 4,000 this morning. So also looking at then the biases around this phase, we can see there's the disposition effect and also loss aversion. Now to better explain loss aversion, I'm going to speak a little bit about the utility theory and the prospect theory, which are kind of a tangent, but I think very important in order to better understand behavioral economics as a whole and also better understand kind of disposition effect. So investors have a tendency to sell assets that have been doing well and whose prices have risen, and sell assets whose prices have decreased. So as Barber found in 2009, when looking at individual investors, they tended to sell stocks that were doing better than the stocks they bought in exchange. And so this is linked to loss aversion, and I'm going to talk a little bit now then about utility theory. So utility theory really is more traditional economics, and what we can see is that when looking at utility and gains in wealth, the first derivative is positive, and so this means that people have increasing utility with wealth. However, the second derivative is negative, and so that means that the curve is concave and marginal utility decreases with gains in wealth. So let's say that the stock price for an asset today is at this point, so that's a sure wealth. And in comparison, we don't know what it's going to be tomorrow, but let's say it can be one of these 2 points that gives us uncertain wealth. When looking at the average utility from the uncertain wealth in comparison to the certain wealth, we see that actually there's less utility, or people are less happy then about taking on that risk, and that explains risk aversion. So prospect theory takes the utility theory and also looks at what happens when we take into account losses. So we can see that changes in wealth, so it's looking essentially at changes in wealth, sorry, and we can see that there's a higher slope at 0 for losses than gains, so people care more about losses than they're happy about gains. And it's convex in losses and concave in gains. This means that people are risk averse in gains versus risk seeking in losses. And people then in losses, because they are risk seeking, overestimate small probabilities. Now this explains the disposition effect, because people are willing to have that secure bet, so secure their wealth in gains, and then they want to see what the market's going to do in the future in losses. So finally, we enter the 4th stage, which is stabilization. So we can see that at this stage, really, the learning curve plateaus. And so people are paying less attention to each additional bit of information and future volatility in the market. So this leads to more passive investing patterns and stronger familiarity, and also a stronger connection with one's investments over time. And so because of this, you have less rash decision making. But just because you're less rash doesn't mean that you're going to have less biases. So you still have the endowment effect as well as the familiarity bias. In the endowment effect, you're looking at investors and somewhat how they tend to overvalue assets that they already own. So they're going to be, for instance, unlikely to sell investments that they have owned for a long time. And this is an example of what happened in India. So with IPOs, when they're overprescribed, there's a lottery that is put into place. And so here we're looking at lottery winners and lottery losers. So for the winners of this lottery, at first, so they actually tended over the long run to keep their shares of their shares, whereas people that had lost that lottery were actually not willing to buy shares over time. And so also we have familiarity effect, which is valuing what is familiar over what is novel. And so Gutzman in 2005 conducted a study where he found that people really diversified towards specific industries because of this effect. So in conclusion, people should be very critical of information, but also where they stand in this information curve. So it's important to be mindful of these different biases and also which ones we are maybe more accustomed to at which point in this point of assimilating different pieces of information. And also, so paying attention to more intrinsic value. How do we do this? So diversifying sources of information in order not to be biased towards certain confirmation biases or framing. But also being able to invest independently of current popular beliefs, which might have to do more than with herding bias, and also being mindful of reference points where we might succumb to loss aversion, as well as familiarity bias.
Thank you. Okay, so it's a question time, because here we have the questions after each talk for this afternoon session. Any? Yeah, okay, yeah, because we started a bit late. So is there any question? One question? Yes.
Hi. I was expecting, as the information exposure increases, that you may even have a negative effect. Then information selection should increase, and maybe it might be useful to capture the effect of fake news today, which are actually driving often market conditions.
Well, that's actually interesting. So essentially the idea then is as your familiarity with information increases, you are kind of able to dissect your way through the wave of information overflow and abundance. And so in a way, I guess you become more selective to what you're paying attention to, but you're also maybe paying less attention to it at large. That being said, there have been cases where people actually pay more attention or increase their own assumptions as they find kind of like polarizing fake news and things like that. And so especially in light of like a more recent context, it's interesting when looking at, for instance, data on Trump supporters and when they are faced with people kind of going against Trump, then they tend to actually reinforce their belief in him. So I don't know if that answers your question, but
Thank you very much. Bravo.